Welcome to this explainer. Today, we're going to dive into something that touches literally almost every single person on the planet, yet it somehow remains one of the most outdated systems in the modern world. We're talking about the massive 300-year-old, totally paperwork-heavy insurance industry. And more importantly, our sources highlight a core mission of transforming it from the ground up using blockchain technology. Now, before you completely write off the word blockchain, stick with me for a second. This isn't about crypto speculation or anything like that. It's about fundamentally fixing a broken system we all have to interact with. Insurance is a promise. You pay every month. If disaster hits, they pay you. Simple. Except it isn't. I think this quote perfectly captures that universal frustration we've all felt. You faithfully pay your premiums every month into what feels like a black box, but the second you actually need to use it, bam, you hit a wall of fine print, claims adjusters, and endless phone calls. The trust is just broken. Okay, I want you to think about this number for a second. 40 to 90. That is the average number of days it takes to actually get paid for property and health claims today. And if it's a major catastrophe, like a hurricane, that wait can easily stretch to 18 months. While you're sitting there waiting for a check in the mail, you're probably borrowing money just to rebuild your life. And the interest you're paying on those loans, it basically acts as a massive hidden deductible. It's just a completely inefficient system. So, here's how we're going to break it all down today. 1. The broken promise. 2. Enter parametric insurance. 3. The limits of code. 4. Liquid capital. And 5. The 2035 invisible infrastructure. All right, let's jump right into Section 1, the broken promise and those hidden insurance taxes. When we look at how your premiums are actually broken down, it's pretty shocking. Only 65% of your money actually goes toward paying claims. The rest of it? Well, 15% goes to customer acquisition, 10% to admin, and 5% directly covers the cost of fraud. That means a massive 35% chunk of our premiums is completely eaten up by the machine before a single claim is even paid out. To put that in perspective, if you want a simple $10 a month policy, it might literally cost the company $15 just to service the paperwork. It completely prices poor demographics out of even participating. The real-world impact of all these inefficiencies acts as a series of hidden taxes on our wallets. First, we've got the payout lag, which, like we mentioned, forces you to borrow money just to rebuild. Then there's the fraud tax. Fake claims cost the U.S. alone $40 billion a year. That means honest customers, like us, are essentially paying 10% more just to cover the liars. Next up is the admin tax, which burns through $80 billion a year on paper, phone calls, and totally legacy systems. And finally, the trust tax. You don't trust them to pay, they don't trust your claims, so everybody hires lawyers. It is an absolute financial dream. Which brings us to Section 2, enter parametric insurance, where absolutely no adjusters needed. So what is this? Well, at its core, parametric insurance is basically a smart contract that automatically pays out a fixed amount the moment a specific event happens. If rainfall is less than 200 millimeters, it pays $200. If your flight is delayed more than 2 hours, it pays $100. It completely removes the human element from the equation. There's no proof of loss to submit, and there's absolutely no claims adjuster driving out to look at your house. If the data shows the event happened, the money just goes out, pure and simple. If we contrast the traditional model with this new parametric model, you can really see the paradigm shift. In traditional insurance, a loss happens. An adjuster comes out to sort of subjectively measure the damage. And then, eventually, maybe, they pay for that damage. In parametric, an event happens, and boom, it automatically pays a fixed amount. No adjuster involved. What we're doing here is shifting away from trusting a brand and an underwriter to simply trusting pure, immutable math. And this isn't just some sci-fi theory, guys. It's already happening in the real world. Over in Kenya, a project called Etherisk provided crop insurance to 20,000 farmers. They tied the policy directly to satellite rainfall data. So when the season ended and the satellite data confirmed a drought, the smart contract automatically paid them out in stablecoins directly to their phones within 24 hours. No arguments, no disputes. Then you have AXA Fizzy, which tied policies to global air traffic data. If your flight was delayed, the money was literally in your account before you even reached the customer service desk to complain. It's instant, humanless technology, making people's lives so much easier. Okay, but let's do a quick reality check here for Section 3, the limits of code and where parametric insurance actually fails. To understand the limits of this tech, you really have to understand this one term, an oracle. See, a smart contract on a blockchain is entirely blind to the outside world. It has zero idea if it's actually raining outside or if a plane took off. An oracle is simply the data service that feeds that real-world information onto the blockchain. In a parametric system, because there isn't a human verifying the claim, the oracle effectively becomes the new claims adjuster. Which naturally leads us to a pretty massive question. But what if the oracle lies? Or, what if its sensors are just broken? If the data coming in is wrong, the payout going out is going to be wrong. Garbage in, garbage out. So while blockchain totally eliminates the need to trust an insurance brand's claims department, it shifts that exact same burden over to the data. You now have to trust the oracle's data. Trust is shifted here, it's not entirely eliminated. Because ultimately, you literally can't code a broken leg. Indemnity claims, which is where the insurer needs to pay for the actual specific loss sustained, like a really complex health issue or a liability decided in a court of law, or a massive $1 million commercial property fire, those are always going to require human judgment. Blockchain isn't going to replace human adjusters in those really complex scenarios, but it will dramatically streamline the paperwork behind them. Keeping our expectations grounded is super important here. All right, let's move to the back-end revolution in Section 4, liquid capital and reinsurance. Right now, today, insurance data is completely siloed off. Insurer A doesn't talk to Insurer B, which makes it insanely easy for bad actors to submit the exact same claim to two different companies and get paid twice. But with a shared ledger, insurers can securely share a single append-only version of the truth using something called zero-knowledge proofs. This basically means they can share cryptographic proof that a claim exists without giving up any customer privacy. Now, it doesn't stop a fraudster from telling a lie in the first place, but it absolutely stops them from changing their story later. Pilot programs have actually shown this alone can cut fraud by 30%, which saves billions of dollars. What's really fascinating here is how this technology attacks the underlying cost of capital. Every insurer actually buys insurance for themselves to cover huge disasters. It's called reinsurance. Today, that is a slow, opaque, $600 billion market tied up in paper contracts that lock up capital for months or even years. But on the tokenized side, this turns into 24/7 liquid pools of capital. Instead of needing millions of dollars to participate, someone can back a pool with a fractional minimum of just $1,000. This liquid capital earns yield instantly, making the whole operation incredibly efficient. And guess what? When insurers save money on capital, your premiums go down. Finally, let's look at the ultimate end state for all of this in Section 5, the 2035 invisible infrastructure. One absolutely crucial takeaway from our sources is this: a token does not equal a policy. You are not going to need to manage a crypto wallet or remember some 12-word seed phrase just to buy car insurance. True success in this industry means blockchain becomes completely invisible plumbing. Think of it exactly like the SWIFT network in banking. You probably don't know exactly how SWIFT works under the hood. You just know that when you send money internationally, it gets there. Blockchain is just going to be the invisible back-end rail that makes everything faster. Imagine this 10-second future with me. Step 1. You get into a minor fender bender and you just snap a photo on your phone. Step 2, an AI instantly assesses the damage from the image. Step 3, an oracle pushes that verified data straight to the blockchain. And step 4, the smart contract automatically executes and pays out directly to your bank account. 10 seconds. Companies like Lemonade are actually already combining AI and chain technology to settle simple claims in literal seconds. It's wild. It really all boils down to this one core idea. The goal isn't to decentralize risk, it's to pay claims fast. Smart contracts aren't going to replace the fundamental concept of insurance. They're just going to replace the 30% of insurance that is pure paper, delay, administrative bloat, and fraud. So I'm going to leave you with this provocative thought as we wrap up this explainer. When disaster strikes your home, your farm, or your family, would you rather wait 90 agonizing days for a paper check to arrive in the mail, or wait 10 seconds for the code to execute? The transition is honestly inevitable. Thank you so much for learning with me today, and I really hope this gave you a whole new perspective on the automated future of those policies sitting in your drawer right now.